number in the world of finance that tries to do the impossible. It tries to capture the entire future in a single snapshot. It's one of the most common patterns out there, but it's also one of the most misunderstood. So let's dive in and try to decode it. It really all starts with a simple question, right? Why this huge gap? Why would one company's dollar of profit be worth so much more than another's? On the surface, it can look totally random, but it's not. This number, it's a signal. It's a pattern that reveals what the entire market collectively believes is coming tomorrow. And there's a specific tool investors use to read it. To even start, we've got to understand the basic language the market speaks. We need to get a handle on how it puts a price on a single dollar of a company's profit. And that tool? It's the price-to-earnings ratio, or PE for short. It's a real cornerstone of what people call fundamental analysis. To put it simply, it's the price you pay for $1 of a company's annual profit. So if you see a PE of 15, it just means you're paying $15 for every $1 that company actually earns. At its absolute core, the whole idea is really straightforward. It just breaks down into two pieces: the price of a share, what you pay, and the earnings per share, what you get. It's a direct comparison. But is it really that simple? Well, if this were just about what a company earned last year, the math would be pretty easy. But the market isn't just looking in the rearview mirror. It's constantly trying to look through the windshield to see what's on the road ahead. And right here, this is the central challenge. A PE ratio that's based only on past earnings has this built-in flaw, right? The past doesn't always tell you what's going to happen in the future. The real story, the one the market is actually trying to put a price on, is whatever happens next. So this is the key thing to wrap your head around. The PE ratio isn't really a score for last year's performance. It's more like a price tag for next year's potential. It's a single number that tries to bundle up the market's collective forecast, all its hopes and predictions for a company's growth. And this brings us right back to where we started. Why on earth would you pay a high price, maybe $30, for just $1 of what a company is earning right now? Well, the answer is all in the story the market is telling itself about that company's future. You can think of a high PE ratio as basically a vote of confidence. The market is signaling that it believes a company's earnings aren't just going to stay flat, they're going to grow, and probably grow quickly. People are willing to pay a premium today to get a piece of what they believe will be a much bigger pile of profits tomorrow. And this isn't just some abstract theory. We see it happening all the time. Just look at how market analysis from big firms like JP Morgan talks about things like the AI supercycle. They're explicitly forecasting that this trend is going to drive earnings way up. That very expectation gets priced right into the PE ratios of companies in that whole sector. So you see, this expectation isn't just some random feeling people have. It's built in layers. It starts with a company's history. Then you add the context of these huge industry trends. And it all ends with a projection of what could be. Okay, so if a high PE means the market is expecting great things, does that mean a company with a low PE is always a bargain? Well, not necessarily. It turns out context is everything. A low PE can also be a story about the future. Just a very different kind of story. It might be signaling that the market expects slow or even declining growth. Or it could be a warning sign about some underlying risks in the business, or maybe even its entire industry. This is exactly why you can't just compare the PE of, say, a stable, predictable utility company with an innovative, high-growth tech company. It's like comparing apples and oranges. One offers slow, steady, predictable earnings. The other offers the potential for explosive growth, but it comes with a lot more uncertainty. They're telling two completely different stories about the future, and because of that, they get two completely different PE ratios. So we've been talking about expectations and stories, and it all sounds very human, doesn't it? Well, that's because it is. The PE ratio isn't just some cold number spat out by a computer. It's the result of this vast collective human mind at work. When we use a clinical term like the market expects something, what we're really describing is the sum of millions of individual decisions. And yeah, those decisions are driven by data, but they're also driven by belief, by hope for what's to come, and by a very real fear of loss. And it's not just us saying this. Academic research in an area called behavioral finance actually confirms it. Our human psychology, with all of its quirks and biases, plays a huge role. We tend to follow the herd, we can be overconfident, and we feel the pain of a loss much more than we enjoy a gain. These instincts are what drive market sentiment, and that, in turn, absolutely influences the PE ratio. So that final PE number we see, it's a blend. It's part rational calculation based on spreadsheets and financial statements, and it's part psychological storm of human behavior. The number reflects both our logic and our instincts. So after all of this, what's the key takeaway? How are we actually supposed to read this pattern we've been decoding? Okay, first and most important, it is not a crystal ball. A really high PE doesn't guarantee a stock is going to go up, and a low PE definitely doesn't guarantee it's a safe bet. The future can, and very often does, surprise all of us. Instead, try to think of the PE ratio like a tarot card. It doesn't magically predict one specific future. What it does is reveal the energy of the present moment. It shows you the dominant story, the collective belief system that is actively shaping what comes next. And your job isn't to blindly follow it, but to understand it. By understanding the PE ratio, you're really learning to read the market's mind. You get to see the narrative that it has built about growth, about risk, and about what's around the corner. So the real question becomes, after seeing that story, do you believe it?
Here at Neural Tarot, we believe that learning to see these patterns is the key to truly understanding the world around us.
Subscribe to continue the journey with us as we keep decoding the invisible forces that are writing the story of our future.